typical credit repairer. So if you ever have any house hunters that want to buy, but they're not quite sure that they're where they need to be, Chris is a great starting point to help get them on the right track. And Erica is also with Elevate My Scores. She's actually the area representative, so she would be the perfect person to reach out to locally. And then I also have Denise Nelms here. She's our lunch sponsor. She's with Pelican View Drone Services. And after the class, she brought a couple of drones. They make some great aerial photos of properties if you have any listings or anything like that. And she's going to tell us a little bit about their capabilities and let us check out the technology, which I think is awesome. And we'll be having lunch directly following as well. So have an appetite. There's juice and water and coffee in the meantime. And other than that, I'll turn it over to Chris. Thank you, guys.
Right.
Thank you. Thank you, Jill.
Thanks, guys. Well, we'll let our lunch sponsor speak a little bit first, but just wanted to introduce myself and Erica, who's our area rep. So, Erica, if you want to introduce yourself real quick.
Hello, Erica Bias. I am the Houston area, all over the Houston area. I actually grew up in this area, so I know this southern area very well too.
All right. Thanks. And our sponsor, if you want to take 10 minutes or 5 minutes or whatever.
I thought I would just talk about what to eat later. If that's
Okay, you want to do that? Okay, great. We'll do that then. So what we'll do is, I was actually going to have her talk like rapid fire. I'm just going to go rapid fire.
While he's doing that, I am going to pass out some raffle tickets. We've got 3 raffle items that we will draw for the end. So best of luck to you.
All right, well, while she's doing that, we can go ahead and get started. Now, did everybody sign in on the sign-in sheet? Okay, so just important, that's how you get credit for the class. So it looks like we got a pretty good turnout today. So how it's going to go is we're going to, as we go through this, if you have any questions, feel free to ask me any questions anytime. If you have questions that are specific to you or to a client, let's hold those questions till the end. And I bring this up only because it's happened. So like if you're like, oh hey, I got a question about inquiries, and I actually brought a credit report for myself and my clients. Can you take a look and stop the class and do this? I'm like, and that's happened. So let's hold those kind of questions till the end. Anything that's specific to what we're talking about, certainly please chime in, ask questions. We'll be bringing Abe and Ray in to ask questions, and they'll certainly be piping in because they've got a lot of knowledge about credit as well, because obviously they deal with it every day. Now you should have a packet in front of you that's got a place to take notes in the back, and it also has kind of an outline of the presentation. Please, they're yours. Take notes all over them, and always, reference back to them. I still get phone calls all the time from realtors like, "Oh, I had a question about this," and it kind of helps you. This is also kind of your cheat sheet or your crutch with your clients when you're talking with them. So my passion really is teaching about what I know about credit. I've been in the credit business for 10 years, so I've helped thousands of people get qualified for home loans over the years. And so teaching this to realtors is a big passion of mine, because I feel like you guys are on the front lines. You're the ones that are out there talking to the clients, sometimes even being that shoulder to cry on when they realize they can't get that home. So, when things go wrong or whatever, you're going to be the one there to talk with the client, and you're the one that gets that relationship with them. So that's why I think it's so important for you guys to understand just some of the fundamentals of credit. So that being said, we're going to go ahead and get started. So what's in a credit score? When you look at a credit report, now how many of you guys have actually taken the opportunity to look at a mortgage credit report? Yeah, go ahead. Yeah. And this is on Facebook Live, by the way, so you can always go back. So that our Facebook page is pretty simple. It's just Elevate My Scores. So if you guys want to take out your phones now and go over there right now and like the page, That way you'll get updated on all information, blogs and stuff that we do, videos, and also any Facebook Live events. So you can always go back and watch these. There's probably some that will sound better than this one just because of this area, but I tell the same jokes and everything, so if you listen to them, you'd be like, wait a second, that's really not that funny when you tell it the 18th time. So, but if you laugh, it makes people seem like it's for the first time. So back to this. So the how many people have taken a look at a mortgage credit report? A few of you guys. Okay. Now, when you looked at it, you saw 3 different scores, right? Now, did you ever wonder why the scores on there with the different bureaus were actually different? Does anybody have an idea why they're different?
Different algorithms.
Different algorithms? Okay, he's watched some of my classes online. So, no, he's done some study. Yeah, that's a big part of it is algorithms. But also, different creditors report to different credit bureaus. So you may have a medical collection that gets reported to TransUnion and another medical collection that gets reported to all 3. I've also seen this where different credit card companies will actually report different information to different credit bureaus at different times of the month. So you may have a Capital One trade line. Now, when I talk about a trade line, I'm talking about the item that describes that particular credit item across all 3 credit bureaus. That's what a trade line is, okay? So let's just say it's Capital One, and they report to TransUnion and Equifax a limit of 500 and a balance of 110, and then Experian shows a balance of 495. And so Experian, the score is going to be impacted differently because it's reporting a different balance according to the credit limit. And we'll talk a little bit later on how that can impact the score, but that's just an example of how things can get reported differently because sometimes they will report to different credit bureaus at different points of the month. So those kind of things can make differences in credit scores and why you see those different scores on there. But like this gentleman here said, that biggest thing really is algorithms. So basically there's different mathematical formulas that are used to compute a credit score. Now when Abe and Ray pull a copy of a credit report, they're going to use 3 specific algorithms, but there are actually over 100 different algorithms that are used to compute a credit score. Now, how many people look at your credit score on your phone? Through Credit Karma or an app like your Discover or Capital One or something like that, where your credit card companies now show you your credit scores. Now, how many people that look at it on their phone think that that's the same thing that Abe and Ray would pull for a mortgage credit report? Nobody? That's good. It can sometimes be quite a bit different. Now, even though Discover and Capital One and some of these others will tell you, well, this is your FICO score. Now, how many people believe that that FICO score is the same FICO score that Abe and Ray would pull? It's not. It's not the same. Because there's actually 49 different FICO algorithms. That means 49 different ways to come up with a FICO credit score. Well, how is that possible? Isn't a FICO score a FICO score? Well, no. Just like a credit score isn't a credit score, a FICO score isn't a FICO score. But FICO, has anybody heard the term FICO before? Okay. Yeah. That was my next question. Anybody know? He probably knows what it means. I'm putting you on the spot. He's answered every other question so far, so I figured he'd know. I'm just kidding. Fair Isaac Corporation. So Fair Isaac Corporation basically invented credit scoring back in the 60s. And they're still pretty much the law of the land when it comes to credit scoring and credit algorithms today. Now, 90% of all lending decisions are done using a FICO-derived algorithm. Okay, so it means if you go to a bank, you apply for a credit card, you apply for a car loan, you apply for a mortgage loan, you apply for a boat loan, it's going to be a FICO credit score. Okay, now when you go buy a car, is it going to be the same score that Abe and Ray pull? No, it's not. Okay, there are what now I think the terms in the auto business change all the time, but now they call it auto enhanced. They used to call it a beacon score. But they have a auto-enhanced version of their own credit algorithms that are used specifically for the auto industry. Now those are actually done on a different scale than a mortgage FICO algorithm. So the thing that I'm trying to get to is to understand that when Abe and Ray pull a credit report, they're pulling something that's specific to the mortgage industry. And when you go buy a car, you're pulling something that's specific to the auto industry. Now in the auto industry, the range is actually 50 points higher than a mortgage range. Now the range of a mortgage FICO score goes from a 350 to an 850. In the auto industry, it goes up to a 900. That means the highest possible score would be a 900. The highest possible score in the mortgage industry is an 850. That's one reason why whenever you go get have your credit check for an auto loan, it's going to be higher than it was if you're buying a home. So if you kind of do the same, both of them on the same weekend, you apply with Abe and Ray online, and then also you go go buy a car that same weekend. The scores will be different, and the auto score would be much higher, and it could be about 50 points higher. Now in the mortgage industry, how many people think there's 3 algorithms? You're probably like, I'm not falling the first trap anymore, because the answer is always no, right? No, there's not only 3 algorithms. There's actually 9 different algorithms that are used in the mortgage industry. But of course, when a mortgage credit report is pulled, only 3 of them are used. One for Experian, one for Equifax, and one for TransUnion. But they're 3 different ones, okay? The point of all of this that I'm telling you is just to really understand that when your clients are the ones that are going to get confused. They're the ones that are going to Credit Karma, seeing that their score is a 630, and they're thinking, hey, I read on a blog somewhere that I needed a 620 to qualify, so hey, I'm good, let's start looking for homes. You need to say, hey, slow your roll, let's have Abe and Ray pull your credit report first, so then we can have them and look and see what your mortgage score is, and based on their guidelines, do you qualify, okay? Because they have stuff that you can do that's even, and I'll let them talk about their qualifications, but they can work magic on their stuff. So always have the mortgage professional pull first before you ever just assume they can't get qualified for a home loan. But the point is, people sometimes make decisions based off of wrong information, and so it's important for you to understand as kind of that person that's right there in front of them to let them know that, hey, hold on before you do anything, okay? And we'll talk about this as we go through the presentation, other things that you'll need to know to kind of let your clients know, like, hey, don't do this, talk to a professional first. And this is one of them first, which is the credit score itself, okay? Now the different industries where your score is calculated, we talked about home, we talked about auto, but also insurance, credit card, and then also the internet. I alluded a little bit about Credit Karma. Now Credit Karma uses what's called the Vantage scoring model. That's Vantage with a V. And right now they use an iteration called Vantage 3.0. Now when Vantage first started, it was drastically different than FICO. The top score went to a 990, and I told you in FICO goes to an 850. Well, now the top score in Vantage goes to an 850. However, the scores are still pretty radically different than a mortgage credit score. But instead of being 120 points different, now they're more like 30 or 40 points different than a mortgage credit score. And they're usually higher than a mortgage credit score. And it's because they look at different things. We're going to talk about the mortgage FICO algorithm today, but they talk about different things, or they look at different things when they're scoring your credit score versus what a mortgage looks like. Okay. Any questions? Did I confuse you guys at all? You're still with me? Okay, good. So far. One other thing I wanted to bring up too, because I mentioned how the FICO scores, when you look at your Discover app and stuff, and why those are different. So a lot of those are using what's called the FICO 8 scoring model, which is a pretty prominent one that's out there to kind of just show you what your FICO score is. But again, it's still going to be higher. It's going to be more in line with what a Vantage score looks like. and it's going to be higher than a mortgage credit score. There are some lending decisions that are used using a FICO 8 score, but a lot of times when you go to like your Discover app and those places that are saying, hey, here's your FICO credit score, it's a FICO 8 score, and it's usually going to be about 30 to 40 points higher than your mortgage FICO score. So your mortgage FICO score will actually be the lowest of all the different scoring algorithms. Don't blame Abe and Ray. They did not do them. They just work in the business, right? So. Because I actually had a lady that yelled at me and then started cussing out the loan officer that referred him over because her scores were different than their Credit Karma app. And I'm like, well, it's not my fault. It's not their fault. We didn't do it. And we're not the one that screwed up your credit either. So. Yeah. So this is a breakdown of the mortgage FICO scoring model. We're going to spend quite a bit of time here talking about the different sections in the mortgage FICO scoring model. There's 5 sections total in this pie. The first one we're going to talk about here is payment history. It's 35% of your credit score. Now this is where all of your payment information shows up. So anything you're making payments on, your mortgage loan, your car loan, your boat loan, student loan, credit cards, everything you're making a payment in is going to calculate here into this section. Now the more payments you make on a particular trade line, I'm using that word again, on a particular trade line, the more it's going to positively impact your credit score. Now, a credit monitoring service will not show you this information, but when a mortgage credit report is pulled, you'll actually see a notation on there that says months reviewed. So that's the number of payments that have been made on that particular trade line. The higher that number is, the more positively that trade line is going to impact the credit score. So this leads a lot of people to think, questions that I get like, well, hey, if I just pay my truck off, won't that help my credit score? I'm like, well, not necessarily. It's because that particular trade line is scored on the number of payments you make, okay? And we'll talk about differences between installment and revolving here in a little bit, but and I'll come back to this at different points in the presentation, and I'll talk about that month's review, but it impacts this section pretty heavily, okay? And then also what it's impacted in this section is your negative information. So your charge-off collections, tax liens, late payments, collections, all of that kind of stuff is all impacted here in this section, okay? Now the next section here is amounts owed. It's 30% of your score. Now this is going to be your revolving accounts. When I say the word revolving accounts, do you guys know what I mean? Who doesn't? Okay, don't have to raise your hand. So let me just explain real quick the difference between revolving and installment. So a revolving is a credit card, okay? Now the reason why it's called revolving is it's kind of like a revolving door. You charge something on it, you pay it off, you can borrow back against it again. So if you have a $1,000 Capital One credit card and you buy a $900 set of tires on there, well now you're utilizing 90% of it, right? We'll come back to that number in a second. But if you pay it off down to $300, well now you've got $700 available you can spend on it again, okay? It's revolving. But if you have a truck loan, I drive a truck, so I always say truck instead of car, and we're in Texas, so if you have a truck loan, and let's say it was for $30,000, you get it paid down to $15,000, you don't have $15,000 of available credit you can go borrow back against. You can't say, oh, I need a new set of tires, I'm just going to go back and borrow some money against that $15,000 that I've already paid off on my truck loan. You can't do that. That's not how it works. Okay. Now, sure, you could probably say, oh, yeah, you can pull out equity or whatever in your truck. That's different. That's starting a whole new trade line. You can't, and you're starting it against an asset, and that's not the same thing as borrowing back against the trade line on a credit line. Okay. So an installment is you have a fixed payment, $300 a month for 60 months. You pay it off, you're done. Okay, and then that account closes. A revolving account, you have it until you close it. So a revolving account can actually be your most powerful trade line on your credit report, even more powerful than a mortgage, because you can have it for longer than a mortgage. Like, well, how's that possible? Well, it is. I mean, the best credit report I've ever seen was a guy who had an American Express card, a Shell gas card that were opened up both in the early 60s, and then a mortgage loan that was 20 years old. So the two credit cards he had were significantly older than the mortgage that he had. And he had an 837 credit score as a result, okay? Which is the best credit score I've ever seen on a credit report. So to understand that piece, that you understand the difference between revolving and installment. Now let's talk about, well, what is revolving and how does it impact your credit score? So we talked about that percentage. I mentioned 90%. So that is what's called your utilization ratio. The higher that number is, the more it's going to impact your, the more it's going to impact your credit score negatively. Okay, so you have a higher percentage of utilization, the less that item is going to be contributing to your credit score. The lower that percentage is, the more it's going to be contributing to your credit score. Let me just kind of give you an example. So with that 90%, at 90%, you're losing 90% of the points you could potentially be earning toward your credit score. So theoretically, let's say that credit card earned you 100 points, and it doesn't, but let's just say theoretically, that means at 90% utilization, and you're losing 90% of those points, how many points would you be earning toward your credit score? Anyone? 10 points, yeah. I know some of you are like, I was told there'd be no math. Yeah, so 10 points, exactly. But now if you take that same credit card and pay it down to $300 at 30%, you're only losing 10% of the points. So I'll help you with the math. That means you're earning 90 points on that one in that scenario. Now, there's no credit card that's going to earn you 100 points. I don't want you to think that, but it's a good way to kind of illustrate how paying that down, the percentage, increases your credit score. And so when Abe and Ray pull a credit report, a lot of times they're going to do what are called simulators. So they have simulators that they can go in and say, oh, well, I need X score, so, or how much can be paid down in order to help raise the credit score, and it'll tell them, if you pay X down, you'll get so many points. So they can do that really quickly for your clients, and they can actually get it done pretty quickly to where they can turn it around and say, okay, now we got the score that they need based off of the client throwing, $600 down on paying on their credit card. Okay.
So are you saying that it's better, because I kind of operate on a cash system, probably do this. So are you saying it's better to have credit cards and not use them than not have credit cards at all toward your credit score?
So it is definitely better to have credit cards. So the one thing that you have to note about this section, if you do not have a credit card, you do not score in this section. Okay, so that means you only score in 70% of the credit model. You're missing out on almost a third. It'd be like ordering a pizza from Domino's and they show up and there's 2 slices missing. So it's kind of what's happening here if you don't have a credit card. So, and there's a lot of people, that live on the cash system, and there's nothing wrong with that. You can continue to do that. And actually, when we have our clients, and we'll talk about building credit here in a little bit, but we talk about very specifically, hey, you can still have credit cards and use it on things that you spend for cash anyways, like groceries and gas. Okay, when you go to the gas pump, you pull out your debit card, you put it in. Well, this time you're going to pull out your credit card and pull it in, and you're going to pay it off. You go to the grocery store, you pull out your debit card and pay at HEB. Well, guess what? This time you're going to pull out your credit card, you're going to pay for it, and then you're going to pay it off. That's something you're going to spend cash on anyways. It's not like, hey, go get a credit card and then go to Sam's Boat and be like, shots on me. No, that's not what we're saying. But you have to have that credit card in order to help build your credit score, and it's because of this section right here. And the older those credit cards are, the more positively they're going to impact you in here in this section, and the more points they're going to earn from you. Going back to that percentage, somebody's like, well, how many points does a credit card earn me? I'm like, well, it depends. So an older credit card is going to earn you more points in this section than a younger credit card. So that means that up and down of that utilization is all geared towards how much does that credit card earn you at a theoretical 0. Okay. Now, why I say theoretical 0 is because it actually never them all the way down to zero because there's a slight quirk in the algorithm that if you leave like $5 or $10 on there, it scores slightly higher than zero. I'm not 100% sure why. My theory is it has something to do with the activity level of the card, but I don't think there's a real clear reason. But I do know, and you know, these guys can tell you too, that having a small balance on a credit card has a slight uptick versus a zero. So I'll say theoretical zero because of that reason. Okay. So understanding like what your balances are on your credit cards are very important. Now, obviously, if they're maxed out, I think most people know that, hey, my maxed out credit card is impacting my score. But a lot of times when I'm talking to people, I'll say, well, what's negative on your credit report? And they'll say, oh, well, all my credit cards are maxed out. Well, that's technically not a negative. And I know it sounds kind of like semantics, but it's less of a positive than it could be. But it's not necessarily a negative because the fact that you have the credit card to begin with is a positive. It's just not as positive as it could be because they're close to the limit. Okay. Now, if you go over the limit, that can definitely be a negative against you, and it could hit you more than what that score is. So I'm going back to that scenario where a credit card at theoretical zero is earning you 100 points. And if you're at 125% utilization, well, now it's dipping the other way, you know, so it's hurting you negatively. Okay. So I'll tell people all the time that are maxed out or over the limit on their credit cards, like, just get it down to 75%. If you can even just get it down to that much, that's going to have an impact on your credit score. And sometimes if you just need a few points, that can be the difference. But I don't usually see clients that just need a few points and paying down their credit cards is the answer because most of my loan officers are smart enough to know to have them do that and rescore it, you know. Unless they come from Wells Fargo, because Wells Fargo is not allowed to tell clients to pay off credit cards. That's another story. So length of credit history is 15% of your credit score. This is going to be an average of all your open and active accounts, both your installment and revolving. Now, in order to maximize this section, you need 25 years of average credit history, so quite some time. So it is an average. So that means that the older you have a particular trade line, the more positively it's going to impact you here in this section. But it also helps make a lot of decisions about things that you do on your credit and things that when we do what's called credit coaching with the client, it helps us make those decisions. And when people ask questions like, hey, should I close down this credit card? Should I pay off this truck loan? Should I pay off this student loan? It helps make those decisions because sometimes people will say, well, hey, I just paid off my student loan. Shouldn't that help my credit score? Well, no, that was your oldest trade line and now it's closed. And guess what? It's no longer impacting your credit score here in this section. So you probably just lost points because of that. I know it sounds crazy, like, oh yeah, I've had a student loan for 15 years and I finally got it paid off and you're telling me it's not going to impact me anymore? Well, no. Or I just had my car loan for 6 years and I paid it off and bought another car. Should my credit score go up? No, it probably went down because two reasons. One, you opened up a new trade line, and then the other one is you paid off the other one, so you probably lost some history. And people ask that question all the time, like, well, I heard it's bad to close credit cards. Well, in some cases it can be because of this section, but in other cases it can help you because of this section. So if you close down cards that are newer and leave cards open that are older, what have you done? You've increased your average, right? Because you subtracted the lower numbers and increased that higher number average, okay? Because if you have 1 + 1 + 10 + 10, and then you take off the ones and you do an average, well, your average just went up 10 rather than something much lower. So it's all about understanding, and a lot of decisions that we're making when it comes to credit coaching will come back to this section here because we want to make sure we're not impacting negatively the credit history. Okay. Any questions about that? Does that kind of make sense? Now we also talk about depth of credit here too. So if somebody has one credit card and it's been opened up for 10 years and they go open up one other trade line, let's say they go to Kohl's and I want to save some money today and get 20% off my purchase, so they open up a Kohl's card. Well, what's happened to their average credit history? It went from 10 years to 5 years, right? Because it was cut in half because they had one trade line at 10 years, now they have 2 trade lines at 10 years and 0, and that averages out to 5, right? So you don't want to, so that's why it's good to have multiple trade lines that are old in order to help, and this is long-term stuff we're talking about here, to help build that depth of credit. So when I'm talking to people about building their credit, a lot of times I'll say, hey, you need multiple credit cards, 2 to 3, and then when those age, you'll have that depth of credit because they'll all be the same age. You'll have 3 credit cards that are all 5 years. So opening up a 4th one won't really hurt you that much. And even when you go to apply for a mortgage or buy a car or whatever, it's not going to hurt you that much because you've got good depth of credit. Okay, does that make sense? So the next section here is types of credit used. It's 10% of your score. Now here we're looking for what kind of credit do you have on your credit report? Specifically, credit cards versus mortgage loans, things like that, financial loans. Now having too much of a particular item can actually hurt you. I get that question a lot. Like, well, if I have too many credit cards, can it hurt me? Absolutely. But there is a good mix of credit that we look for here. So we want to have a ratio of 3 to 1. So 3 revolving to 1 installment is usually the good ratio to have. Okay. So that's usually when people are starting from scratch, we'll tell them to get 2 to 3 credit cards. Now, and here's where it kind of comes back to that length of credit history. So people say, well, I have 2 credit cards, but that's it. Chris, should I go buy a car or open up an installment loan? Because you said, an installment loan helps. Yes, installment loan can help you here in this section, but if you have 2 credit cards and both of them are 10 years old, does it make sense to go open up an installment loan? Well, no, because it's going to impact you so much on the length of credit history side. The little bump that you'll get by having an installment loan is not going to help you. I remember listening to Susie Orman, and she was doing a credit talk, and everybody's like, oh, she's so awesome. And she was telling people, no matter what, you need an installment loan because of this section here. And I'm like, well, that's dumb because you're not looking at the big picture. So going out and just opening up an installment loan just to open up an installment loan will not help your credit score. It could actually hurt your credit score. So that's where those kind of decisions come in. And when we're doing our credit coaching with clients, we look at a big picture of how a decision is going to impact their credit score. Okay. Now, having too many of a specific item, like I said, could hurt your credit score. An example is credit cards. So I had a client up in Dallas. I know we like to pick on Dallas, being Houstonians here. So anybody here from Dallas? Okay, good. So anyways, she had 25 store credit cards, right? And I was like, do you live near the Galleria? Their Galleria, not ours. She's like, yeah, how'd you know? It's like, well, just a hunch, because she had 25 store credit cards. I mean, literally every credit card you can think of in the mall, she had it. They're all paid on time, no lates, and most of them are maxed out. So she had a lot of stuff going on there, but the biggest thing was she actually had a notation on her mortgage credit report that said too many open store accounts. And that was why, because it was impacting her here in this section. She's like, oh, well, I'll go and, close some down. I'm like, well, let's hold on a second. Let's talk about which ones you want to close down. I may tell you the ones that I think you should close down. They're probably not the ones you want to close down because, that might be one of your favorite stores. But I told her, I was like, we picked, I think, probably 15 of her most recent cards that she had opened. And she had several that were opened up in the last year. I was like, those are the ones we want to, concentrate on closing down. Those other ones you've had open for quite some time, let's keep those ones open because we want to, again, while we're doing this, help you in this section, get rid of that notation about too many open, store cards, but then also help increase that length of credit history. And it worked. It helped eventually over time raise her credit score. Okay. And I've had, a lot of these conversations with clients that have a lot of credit cards. Now, sometimes people, and I actually saw this YouTube video, it keeps popping up. I don't know, it's because it has something to do with credit, it always pops up on mine, where this guy's got like a stack of credit cards. It's like, oh, I got an 800 credit score. I got a stack of credit cards. I'm like, no, that doesn't really help you. I don't know what credit score you're looking at. Maybe there are algorithms out there where that might not take place, but we're talking about mortgages here, and they know that if you've got 50 credit cards, that's probably a high risk because you have 50 open credit cards when you're trying to buy a mortgage loan. So they probably calculate that. Are we expecting a hurricane? It's like was there tropical depression I didn't know about? No. Anyways, sorry. But the point is here, you need to not have too much of a good thing, but then also having too many financial accounts can also impact your credit score negatively. So an example of what a financial account is, how many have heard of like One Main Financial, Sun Loan? I know you guys we see them on their credit report all the time. Sun Loan, places like this. These are places where people go get what I call float loans a lot of times, where they're trying to a lot of times just float themselves from one paycheck to the next. And that's kind of in the industry what they're considered. And it's not a good thing, right? But sometimes those financial loans could be, something different. Maybe they're taking an equity loan against an equity position on a boat or car or something like that. And one or two of those isn't a big deal. But I actually had a teacher in Austin. She had close to 20 of these on her credit report. And she had a notation on her credit report that said, too many open financial accounts. And the reason why was because she had those on there. And I asked her, I was like, well, why, what's going on with you to why you have to have so many of these accounts? Because it makes it look like to a mortgage company that you can't even pay your bills on a monthly basis, let alone be able to pay a mortgage, right? And so that's calculated and factored into the mortgage into that algorithm. But when I asked her, I was like, well, why do you have so many? And she's like, well, I'm a teacher, get paid once a month, which I totally understand. My wife's a teacher as well. It's like I get paid once a month, and sometimes in the middle of the month, my kids want toys. And I'm like, well, all right, first off, let's learn a new word. It's called no. And then you need to stop getting these little float loans, okay? Because it does not look good on your credit report, and it's hurting your credit score. Now, is there anything we can do about it from a fixing perspective? No, it's more about education, which is a big part of what we do with our clients, and this part is educating her how these are hurting her. I had another client that was in a similar situation, didn't have quite as many, but again, when I asked him, why do you have them? He's like, well, I went to, and I'm not going to mention the name of the company, but I went to X financial company, and they said, well, they told me the more of these I had, the more it's going to help my credit score and raise my credit score. I was like, that could not be any further from the truth, and it was very predatory. Now, of course, how do you prove that? It's a conversation between yourself and a loan officer at one of these institutions. But this gentleman had it was like 15 or something on there, and he literally thought he was helping his credit score by doing this. And I think also that he got to the point where he was borrowing more to pay off some of the other ones, and he thought it was like this cycle of him helping his credit score. And he's like, but he didn't understand why his credit score just kept going down, 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 and was in the low 500s. I was like, well, it's because you have all these loans. So, and again, it all comes back to education. So when we're talking about types of credit use, we're doing a lot of educating here with clients more than like actually be able to fix something, because sometimes fixing it is fixing the client themselves. All right. Any questions about that section? So the next one here is new credit, and that's 10% of your score. So there's two parts to this particular section. The first one is anytime you open up a new account, you're going to lose points initially for opening up that new account. That's for a mortgage loan, a credit card, a car loan, a boat loan. Doesn't matter. Any trade line you open, you're going to lose points initially for you're going to lose points initially for opening up that account. And sometimes it can be as much as 30 points. Now, we'll talk about this more when we talk about building credit, but sometimes it can be a necessary evil. But it's just something that people need to understand that, again, that's built into the algorithm, because the highest rate of default happens in the first 90 days of any loan. So that means a mortgage loan, a credit card, car loan, boat loan, whatever. that first 90 days is the highest rate of default, so they calculate that in there, that in the first 90 days, you're gonna lose points. But if you show that over, you can make 3 payments on a particular item, those points go back into your score, okay? Now actually on the mortgage credit report, there is a notation that says, it specifically says on there, length of time since the account has been established. And that if that on there, it's factor code 14 that's on their credit report. And if that factor code 14 is on there, that means they have something on there that is new. But it's also the reason why I tell people if they do open up like a credit card, pay on it for at least 6 months before closing it. Because I've actually seen it where somebody closed a credit card, they only paid on it one time, and that notation stayed on there and it continued to hurt their credit report long term because that particular item was never triggered by having at least 3 payments on it. Okay, I'd say just keep it for 6 months just to be on the safe side before you close something for that reason.
How long is it considered new? Like after 6 months, it's like a new account anymore? Or?
Pretty much, yeah, after 6 months, it wouldn't be really considered a new account. But usually after 3 or 4 payments, technically you're going to get the points back. But sometimes it can still linger depending on your type of, everything that's going on with your credit. Sometimes you may still see that as a factor. Usually people that have better credit, the longer it's going to linger. Okay, those people that have other issues, it's not really going to impact them, from a score perspective that much. So, because the higher you are, the more pickier they get, and the more things they look at to help bring you down. This is kind of the easiest way to describe it. So, yeah, like, some people ask me, like, how much does the collection impact your credit score? It's like, well, I saw one guy that had a $0 medical collection impact his credit score 130 points, but he had an 820 credit score. But another guy that's got that same thing has a 510, it may only impact his score a point, so. Question?
Are you going to medical?
I'm sorry?
Are you going to talk about medical?
Oh, yeah. We still got at least another hour. Yeah, we'll talk about collections and stuff after we'll take a break and order lunch here in just a second.
I have a question.
Yeah, go ahead.
And, like people that were affected by the storm, in my case, I had bought a car and I had been paying on it for like 3 months. And it was, on refinance, and then lost it in the storm. Had to buy another car on credit.
Yeah.
I got paid from the insurance for the car. So would a scenario like that hurt my credit?
It could because you had a car.
I hadn't had it that long.
You didn't have it that long, yeah.
I only had it like 4 months, and then I had to.
I mean, short term, it might impact your credit score, but long term, it should clear itself up.
Okay.
Long term, it'll kind of correct itself. It's mostly because here in what we do, what I do, I'm talking to clients about building their credit long term, but a lot of it is, hey, I'm trying to buy a house in 6 months. So much of what we talk about to clients is short term related things. So something like that, yes, it's tragedy that it happened, but if you're trying to buy a house in a few months, it could definitely impact your credit score. There's probably not a way to just fix it,
Okay.
But if it's something long term, it will naturally correct itself.
You can add a comment to your credit file based on that, right? Would that help?
Yeah, a lot of times it doesn't really help the score, but I see it a lot, especially with my Houston clients, where they have a notation on their credit report that talks about affected by natural disaster, but that does not impact their credit score. All it does is it lets the underwriter know what's going on. So the underwriter, when they're making a decision, and if they're looking at this like, well, it's almost like an LOE type thing where instead of having to go to the step of getting a letter of explanation, it kind of helps. I don't know, Ray, if you want to, when you see that natural disaster notation on a credit report, does your underwriting department look at that trade line any differently?
No, we're gonna look at it and if we have to explain something.
Okay.
It's an ediction. If we have the documentation,
You're still going to need the LOE and all that other kind of stuff anyways.
it just
Yeah.
makes the underwriting department feel better about it.
Yeah. I think that's really what it is. It just makes the buyer feel better about it. It's a good way to explain it. So the other thing that impacts your score here in the new credit section is inquiries, which is probably one of the most misunderstood things in the mortgage industry is an inquiry and how it impacts your credit score. So let me talk a little bit about inquiries, and then I got a question for you. So You've got hard inquiries and you got soft inquiries. So a hard inquiry is going to be when anytime you apply for money or credit, that's going to negatively impact your credit score. Okay. Anytime you have a review pull, like a company that you already have credit with, like a credit card company, wants to review your credit, that would be a review pull. When credit card companies want to give you credit and they do a soft pull, all they're doing is just seeing, are you in a qualifying range? That's still considered a soft pull. Okay, it doesn't negatively impact your score when a credit card company wants to give you credit and they just want to send you a bunch of junk mail. You can opt out of that, and there's an easy way to do that. All that means it doesn't impact your credit score. All it means is you don't get a lot of junk mail. Okay. Well, actually, I've opted out of it, and I still get the junk mail, so I don't know. I think it works only to a point. But then also, whenever you go to a credit monitoring site and have your credit pulled through credit monitoring, like Credit Karma, those kind of places, that's a soft pull. There's no negative impact to your score. It's only when you're actually applying for a loan, credit, money, something like that, that's when it's going to negatively impact your score. I guess the other thing that would be a little bit of a nuance is when you're applying for utilities. A lot of times, like Dish or Verizon, those can negatively impact your credit score. Even though you're not technically applying for credit, in their mind it's kind of credit, like, hey, we're giving you a bunch of equipment and we're trusting that you're going to give it back to us when everything's done. So because of that, they pull a credit report to make sure that you're going to give it all back, and that you're actually going to pay your bill and everything. So they look at it as kind of like credit, even though it's really not, but that can still negatively impact your credit score. I know that right before my wife and I bought our house, we had to do something with Verizon. We switched the account name from my name to her name, even though I'd had Verizon for like 10 years. And because of that, there was an inquiry on our credit report, and it was right before we were buying the home, and we had to do an LOE on that stupid Verizon inquiry to explain that we didn't have an open trade line with Verizon. Like, well, of course we don't. It's a cell phone. Come on. But we still had to do that to appease the underwriters. But it still was negatively impacting the credit score, that Verizon inquiry. So those are things that can negatively impact your credit score. Now, my question is, what do you guys think about inquiries and how they impact your credit score? Or what have you heard, or what are your thoughts? Beyond what I just said, what are your other thoughts about inquiries?
I know I had a Best Buy card that I missed. Well, like, I think it was 7 days.
Oh, you got a late
I was
payment?
at 80 points.
Yep. Yeah, we'll talk about late payments.
Yeah. And it was only about 5 or 6 days. It wasn't even crazy.
Oh no, I have
hit it in like 2 days.
trust me, I have a client right now we're dealing with. His scores dropped 70 points because he missed a car payment by 3 days.
Yeah, it came back in like, but it took it like 3
Yeah,
days.
and he's got a 30-day late now, and they're building a home, and he's like 3 weeks away from closing, and yeah. I'm like, well, you paid it late, and you knew you were building a house. So, but it can, and he got dropped his score about 60 points.
So it was between 60 and 70.
Yeah. But as far as inquiries, what are your thoughts on inquiries? Any thoughts beyond
I know it
what I
works,
just said?
but I don't know how much.
Yeah.
I'm still confused, all of these mortgage companies, they get you to, make your application online and all that kind of stuff. When you make those applications, is that an inquiry, or is that's a soft pull, or?
A lot of times when you fill out the 1003 online, that's a hard pull, right?
Only when the loan officer pulls it.
Yeah.
They will consent to pull, like they give us consent to pull the credit report. What I do is I typically call them to confirm they did apply, and then let them know again further that I'm not pulled. And then I'll probably give them the phone. That way they feel a bit better about it.
Yeah.
So that's a hard pull.
Yeah, when a mortgage company pulls, because if they're going to look at the credit scores, that is a hard pull. Okay. Now, a hard pull impacts your credit score about 3 to 5 points on average per credit pull. Okay. So it means if Ray pulls the credit report, it's about 3 to 5 points. Okay. Now, does that mean that it's going to drop the credit scores down where you can't qualify? Well, no, probably not. And it's not even an immediate impact. It usually takes about 30 days for that to kind of have an impact on the credit score. Okay. It can. Now there are, how many people have heard the term shopping windows? You've heard the term shopping windows? Yeah, so the big question a lot of people have is, are there shopping windows? Do shopping windows exist? And technically speaking, shopping windows do exist in the mortgage industry, in the auto industry, with student loans, but they do not exist with like financial loans or credit cards. Now, what is a shopping window? A shopping window means that if you have so many pulls from a particular industry in a certain period of time, those pulls will only count as one. So if you go to apply for a mortgage and maybe it's the Parade of Homes or something, you have all these different builders pull the credit report, 10 of them, and on a weekend, technically speaking, those 10 should only count as one credit pull, technically speaking. Question? It's either 14 or 45 days depending on the algorithm that's being used. Yeah. So 14 days is kind of a good number to go off of. But I said the word technically for a reason. Okay. Little asterisk there. The reason for that is because when an inquiry happens, it gets coded by type. And that's what gets sent to the credit bureaus. It's the credit reporting company's job to code that and send it off to the credit bureaus. Now, in the mortgage industry, it's not as big a deal as it is in the car industry. So when you go to buy a car and the F&I manager there says, hey, let's, we're going to try to get you the best rate, so I'm going to blast and cast or shotgun this information out there to a bunch of lenders and see who comes back with the best information, the best deal for you. So and let me just illustrate by telling you a story of a client that I had. The loan officer said, hey, can you tell me why my client's credit score dropped 35 points? Here's 2 credit reports for you to take a look at. He bought one car from one car dealership, financed through one company. Now the trade line itself for the car hadn't yet even shown up on the newer credit report. The only thing that showed up on there were the 14 inquiries that happened from when he bought the car. Okay? But he was told when he did all this that, hey, these 14 inquiries will only count as one because it's all going to be put into a shopping window. And he trusted that. And so he just thought it would be a few points. But when his score dropped 35 points, and that actually kept him, because he had an offer on a home, and so that dropped him out of the range of being able to qualify for that home loan at 35 points. So, but when I looked at it, when I looked at those 14, 4 of them were coded as auto, the other 10 were coded as financial. Now going back to what I said, financial, which could be either credit card or like those float loans we talked about, One Main Financial, Sun Loan, those kind of places. Those are financial loans. Those do not have a shopping window. So but when that got coded and sent to the credit bureaus, all of them did not get sent as an auto pull. So of those 14, 4 of them showed up as auto. That means 4 of them counted as one. The other 10 counted individually against him. So each one is about 3 to 5 points on average. So that came out to be a little bit over 3 per pull. So that's why his score dropped 35 points.
Could they get fixed?
Yes, we could. It can be fixed.
Who's responsible for making this?
Yeah, and I get that question all the time. It's a tough. I would think it has to come down to like the Kroll factual data. Who do you guys use to pull credit?
Credit technology.
Credit Technologies. I think it has something to do with those companies. I'm not blaming them or throwing them under the bus. I just don't think they really even know or quite understand. And I think in the mortgage industry, it's not a big deal because like NRL Mortgage, they're NRL Mortgage. They're a mortgage company, okay? But like in the case with this gentleman that bought the car, he did it through Ally Financial, okay? They do auto loans, but they also do other kinds of loans. So how are you going to send that data to the credit bureaus when they're all pulling the same credit report for a financial loan, personal loan, car loan? All of it's pulling using that same, credit report. They may just apply different algorithms depending on what's being used, but they're still going to send it based off of that same financial institution. Now, if it's Toyota Motor Credit or Ford Motor Credit, someplace like that, well, obviously it's going to go across as auto because they don't do anything else. All they do is auto. NRL mortgage, that's all they do is mortgages. So it's going to get sent to the credit bureaus as a mortgage pull, okay? But now if you go to like a Wells Fargo, it could get sent to as financial because how do they know when it's getting pulled? Is it getting pulled as financial? Is it a financial loan? Is it a mortgage loan? Is it a car loan? They don't know, so they probably all just lump them as financial. That's a theory. I'm not saying that is the case, but it's my silly wild ass guess called a swag of why it is, and it's probably close to right. But where were we? Yeah, talking about inquiries. Does that kind of make sense? Now, you asked the question: can it be fixed? Yes, they can. Those anything that's negative on the credit report can be challenged. We do challenge inquiries, and we can get things like that cleaned up and fixed on the credit report because it's not being coded correctly. We can actually challenge that particular item to type. Okay.
What if you're just wanting to know where you sit financially and you want your FICO score and you go to like TransUnion and Experian, the other one, and you pull your credit or you have your credit card? Does that count against your credit?
No, like I said earlier, anytime you just look like a credit monitoring or any kind of credit monitoring site, that's a soft pull. So there's no negative impact to your credit score. Yeah. So.
And how often should you do that?
I recommend people doing it at least, once a year to kind of just see where they're at.
Because that's free once a year, right?
You can get it once a year, but then I guess really technically, I think I have a credit monitoring site. So if you go to our website and you go to check your credit scores, there's a credit monitoring site that we recommend called Identity IQ that we use. If you go through our site, you get a discount off of their services. All of our clients that are in our program are signed up in credit monitoring. We encourage our clients to keep the credit monitoring account even after they, leave the program with us so they can continually monitor. The good thing is with Identity IQ, if something new shows up on your credit report, they alert you. If there's any kind of an inquiry activity, it's going to get alerted. My wife applied we were thinking about buying a new car as we were driving to Texas, we were driving to, or out of state, out of Texas, and she was like, oh, I'm going to see if we want to buy a new car. And then all of a sudden I get an alert on my phone. I'm like, oh yeah, because she put my name on the application and it showed up as an inquiry, right? And I got alerted like that, while we were driving with a text message saying that, hey, there's an inquiry on there, okay? So that, it's good to kind of know that, to constantly see what's on there. So if something does show up on your credit report, it's not like, oh wow, this is news to me. So if you only do it once a year, you may not know that. So I guess, technically speaking, let me backtrack a little bit. It's probably best to continually monitor it.
Does LifeLock do that or no?
LifeLock does do it, and the one thing about LifeLock is you're only able to see a new credit report every year. So it will let you know when things happen, but you can't just pull a new credit report with new credit scores. Now, those credit scores are not going to be the same thing that you see with like a mortgage pull, but it at least gives you an idea of where you're at. It kind of gives you an idea, is your credit in good shape? Is it in bad shape? How do you compare to other people that are pulling their credit report through like Identity IQ? It'll let you know that. So is this a fair score? Is it a good score? Is it a poor score? Is it a very poor score? It will let you know those kind of things. So for that reason, I think it probably is good to kind of continually just monitor it, even though you don't look at it all the time. It can monitor it and let you know if things bad are happening. So, does that answer your question? So let's take a quick break, and we can order lunch. I don't know if we have menus on the table, and just get our lunch order put in, and then we'll get started back in about 10 minutes, and we'll get finished up.
If y'all need restrooms, they're right in the front door, just take a left down that hallway.
Yeah, I was shocked when that happened. I'm like, oh, it's like a
Yeah.
790. It went to like a 700.
Yeah,
I was furious.
yeah, one late payment can drop your scores 100 points or more.
I was thinking like,
sometimes.
okay, no big deal. I'm just about 2 days. There's probably some kind of grace period in there. Not on that one, there wasn't.
Well, It should be if it's only late if it's more than paid 30 days
Yeah,
late.
see, that's where they messed up. Somebody hit it, they hit it, like, there was probably something fine print somewhere on a Best Buy card.
Okay.
They probably hit it like immediately.
So yeah, I mean,
After
if
that,
it's
went
if
by.
it's like, oh, your pay date's on, August 28th, and then you pay it on August 29th, that's not late. It's not late
I
till.
think it was like, like they said, like the 5th, it was like a week late.
But if it's like if your payment's on the 5th and you pay it on the 10th, that's not late.
They did
It's
something
not.
wrong.
It's not. If your payment's September 5th and then you pay it on October 7th, that's late.
Well, it went back up the next month, so obviously something that they caught it or something, you know.
Because that's something that can be challenged because when and we'll talk about the negative stuff, but when we challenge stuff, what we're doing is we're saying, hey, show us the actual payment history, show us where that late payment occurred as far as the statements and everything. We've actually had credit card companies send the statements and the dates of the transaction, so like, oh, here's where we received the payment. They've actually gotten letters like that from the creditors. So
So that credit IQ, that
Identity IQ?
Oh, identity IQ. That doesn't give you a FICO score.
it's not going to give you a FICO score, but like I said, a FICO score. I mean,
It's only gonna be through a mortgage company.
well, there's 49 different FICO scores. So even if you go to myfico.com, the score that they show you on the front page is a FICO 8 score, and it's going to be more in line with a Vantage 3.0 score. Now, if you drill down into MyFICO, you will see a mortgage algorithm on there. It's still not the same mortgage algorithm that Ray and Abe will pull, but it is going to be closer, usually within a point or two of what they pull. But the FICO 8 scores, because like with my Discover card, it tells me a credit score, but I know it's not my true credit score. It's the same credit score that I have on Identity IQ almost.
Like free credit report and all that. How much do you think is different, like when you actually score on that, how they do that one score?
Well, if you do the annual credit report, that does not give you a credit score.
Yeah, I'm on it.
So if you go to
But I
annual,
have to pay extra, like. if I
yeah,
want
you
to
can
go-
pay extra. Yeah, the free one does not give you a credit score. It just gives you the information. Which the reason why they do this, the annual credit report, is they kind of just made it an easier way to get that information. But here's the thing why I tell people not to go to annualcreditreport.com is because in there you actually sign away some of your rights to investigate and challenge negative items on your credit report. So instead of giving 30 days for the creditors to respond to the credit bureaus, you've now given them 45 days, so 50% more time to respond to an investigation. So that what that means is when somebody comes to us and they've gone through annualcreditreport.com and pulled their credit report in the last year, a lot of times they won't get results very that soon, and it makes it a lot harder for us to get stuff off the credit report as a result. So I'm gonna run to the restroom as well. If you want to get order.
Okay.
cheaper.
They are.
You got, like I said, you gotta use it a certain way. If
Yeah.
you're pressure cooker, if you don't, like, open it the right way,
Yeah.
it'll open the pace.
I have a friend who actually had a pressure cooker that blew up in her face. So she had I was watching the news.
So you want these to
Reviewing it, and she talked about it really carefully. I don't know. I've got it on pressure cooker, but I think it's like because it doesn't slow cooking.
Pressure cooker is one. What did that do when they came out?
That's instant.
I always used to say like with scorecards like that, like maybe every 2 or 3 months, like small purchase. Yeah, I mean, I'm not trying to like go spend a bunch of money. Yeah, but you know, if you use them like every 2 or 3 months, it just shows some activity. If you want to like completely show the older the card gets without activity. That's the one you should probably keep active. Because I've actually seen it where. Yeah. You know, whatever. I mean, a scarf or something. I don't know.
Finish your statement, the ones that you have and have no activity on it.
So a good example is I actually had a client, he was an authorized user, and we'll talk about authorized users in a second, but based on his parents' card, so it was showing up as it was his. The card itself was older than him, so I think it was like from like 1982 or something that it was open. It was like an EP gas card, even though he was born in like 1984. Yeah, it makes me feel old, but you know. I told him, like, hey, can you just tell your parents to go? But it hadn't been used in like almost 10 years. But they didn't close it because, I mean, BP is like, well, these people are long-time customers, very good customers. We don't want to close that card, so they kept it open. But because the activity was so old, the last activity, it wasn't impacting the credit score at all. So I said, just go out and have your parents go buy a tank of gas. They did that, and when they did, the score jumped up because it started scoring. They put it back into the scoring. Yeah. They'll buy a Diet Coke or something, or bottled water or whatever.
I have a car that I paid off pretty quickly.
Yeah.
Now, on down service, is there a fee for your service?
We can do it for free, and I just, I steal on the side. Yeah, there's a fee. I would say our fee is very competitive to, compared to our competitors. Sometimes people are like, it's way too cheap, I'm not going to trust you. So yeah, it's a set fee, probably like our cheapest plan. The clients get a discount, so it's only $100 to start. They get a $50 discount, so they take $50 to set up. And then it's a $50 monthly fee, plus all plans. Clients are also required to have a $20 monthly credit monitor. So then they pay $70 a month on our cheapest plan. It depends on their situation. We do have plans that are a little more aggressive, like our most aggressive plan is only $400 to start, $100 off of that. They put a $300 setup fee and $150 monthly fee to include the credit monitoring. But that's
quite a bit more aggressive and includes a lot more services than just the standard. But the standard plan is going to be more in line with like licensing law and creditrepair.com and some of the big, box type credit repair companies. It's going to be very similar to those services. They're still a little more aggressive than theirs. But our most aggressive plan, kind of like the concierge plan as well. If somebody needs to get there in 3 to 4 months, that's the plan that they probably want to jump on. But if somebody's like, hey, I'm on a budget and I've got time, I've got a year and a half, and I'm planning on this early, but I'm on a strict budget, then our standard plan might be a better choice. But we do have a middle plan as well. But you can follow with Erica as well, and you can kind of go over those plans in more detail.
That is on t-shirts tonight. What do they call it? Doors. Okay. I read it somewhere. Wearing golf shorts because he's a golfer. Wearing golf shorts and t-shirts. Oh God, I used to really? Yeah. Now where does your son go? He's with his camera right now. Yeah. He's got like almost a year already, so we would take this one. Yeah, one of those. And where is he going? He wants to be of age. Okay. So that's it. He wants to be of age to get his medical online. But whatever, we'll figure it out. I got her. That is ambitious. Mama's like, I don't know.
That's all they do on here. We're going to fill that Tiger Woods for each other for $9 million. It's a winner take. It's going to be a winner take all event.
So
Between those two.
Tiger Woods are doing?
Fill that
Oh,
and it's on November 23rd.
that's going to happen?
It's on paper. You got to buy it.
Oh, wow. Yeah, we can do that. So we'll get started. I got maybe like 30, 40 minutes more, and then I'll kind of turn it over to you. And then while people, it'll be about the time people are getting their lunch probably. Well, I guess we can go ahead and get started again. Everybody's back, I believe. Does everybody get their lunch ordered? Good. So let's go ahead and get started with building credit. Talk about building credit. And let's go back to the pie chart we talked about earlier. Now, if you look on your sheet, you'll see the pie chart. If you actually take your hand and cover up the 30% section, like I mentioned earlier, you do not score in this section if you do not have a credit card. So that means you're only scoring in 70% of the scoring model when you don't have a credit card. So when we see clients that don't have a credit card, usually they're going to have, and don't have a credit card, they've got some negative stuff on their credit report. These are usually those clients that are in the lower 500 credit scores. And a big part of the reason why their scores are so low is because of the fact that they're not scoring in this 30% section. Okay. So that means you have to get revolving accounts, you have to get a credit card. So a lot of times people say, well, how the heck can I get a credit card if I've got bad credit? Okay, it's like, how do you get a job without a job, right? So there are what are called secured credit cards. Now, when I say secured credit cards, have you heard of these before? Do you know what I mean? Secured credit cards, okay? It's basically you're taking your own money and you're putting it down into a savings account that bank is going to hold on to, and then turn around and give you a line of credit that's typically equal to the amount of money that you've put into that savings account. Okay, let's just say, for example, you go to Capital One, you give Capital One $200, they turn around and give you a secured credit card with a $200 credit limit. Now it spends just like any other credit card. Spends up and down like any other credit card that you have. Okay, and it impacts your score just like any other credit card. Okay, so it's important for people to understand. Now, this is a quick and easy way to help start building your credit. Now, usually, if somebody's starting from scratch, I'm going to tell them, hey, let's go out and get 2 or 3 secured credit cards and 1 installment loan. Now, if somebody has 1 installment loan, go out and get a few credit cards, and that's all they need to do. Okay. But if somebody has credit cards already, am I going to tell them to get an installment loan? Well, it depends. It depends on how long ago did they open up those other credit cards. It's like, oh, I just opened up 2 secured credit cards 3 months ago. Okay, well, yeah, let's go ahead and get that installment loan so we can kind of go back to the types of credit used, get that good mix of credit. Okay, that's all kind of part of the conversation that we have with building credit. Now, for those people that have really, really bad credit scores, they can actually get turned down for secured credit cards. Okay, I stopped by a Regions Bank yesterday, and one of the things that the bank manager there was trying to sell me on was, oh, well, if you have clients that have secured credit card issues, you can send them our way. I was like, okay, well, will you, if somebody has a 470 credit score, will you give them a secured credit card? It's like, yeah, probably not. I'm like, yeah, that's what I thought. And that happens a lot where clients will say, okay, well, I'm just going to go to my bank because I know Wells Fargo, where I bank, offers secured credit cards. So I'm going to go there and they'll give me a secured credit card, no problem. And then they get really upset when they find out they get denied. And those are usually the people that just become renters because they just feel like, I have no hope. Okay? There is hope. All right? We recommend a lot of our clients to go to Open Sky. And it's not some mystery of where to find this amazing credit card, the secure credit card. If you go to creditcards.com and click on their secure credit cards link within creditcards.com, it's listed right there. In fact, there's a whole list of the different secured credit cards and how it has like a table of their offerings, like how much money you have to put down, what the interest rate is, what the annual payment is, all of that. But Open Sky does not pull a credit report. Okay. Number one, it's not going to have an inquiry. And number two, it's pretty much a guaranteed approval. All you got to do is really just have a job and money to put down on a security deposit. You can put down as little as $200. I think it's like a $29 or $39 annual fee, which is not bad. It's got a 17% interest rate. I mean, that's not bad, when you're talking about a secured credit card. But who really cares? Because I don't really care about the interest rate because I just want people to use it very sparingly, once a month. Groceries or gas, $40 or $50, pay it off, down to $5. If you do that, and you have a 25-day grace period on all payments you make, or on all transactions. So anytime you purchase something, you have 25 days to pay that off or pay it down before you get charged any interest. Okay, that's by law. So if you go out and spend $40 on a tank of gas, and then you pay it down to $5, well, you're only going to pay interest on that $5 if you do it the right way. Okay, now interest on $5, I mean, over the course of the year, it's probably less than your cup of Starbucks that you just got this morning. So, actually, Julia runs Starbucks, so yesterday morning. And getting a few of these, 2 to 3, is usually what we recommend. And if we see people that just have the one, and it's within probably 6 months or a year, we're going to have them go out and open up a second one. Because having more of these is going to impact your score positively than just having the one. Because sometimes just one isn't enough. But it's a very important part of starting to score in your on your credit report. Now, sometimes people will see a bump right away. Other times, depending on their situation, it may take a few months for them to really see that bump. Now, there are some very few cases where I've seen where, oh wow, that was a lightning strike on the water. There is very few times where I've seen people open up a secured credit score and their score does drop. They kind of freak out a little bit and they don't understand why. But remember what we talked about? Why does the score drop? You guys aren't paying attention? The new credit, yes, thank you. You guys did pay attention, good. Yeah, so the score dropped because of the new credit, because anytime you open up a new account. But there are times, well, why would their scores go up when they open up a new account? Well, that's because that particular card gave them such a bump that even though their scores did drop, you just didn't see the drop because their scores may have, it may have gotten like a 50-point bump, but they lost 20 points, so they saw a 30-point bump overall, But that also means that when that notation drops off of length of time since the account has been established, their scores are going to go up even more. Okay, so that's why. But it's important to get these right away, especially if people come to us and they're like, "Hey, we need to buy a home in 8 months." They have no credit. Like, well, we need to get on this yesterday as far as building and establishing credit. Okay. Now, big difference between a secured card and an unsecured card. Pretty simple. Unsecured card means you don't have to put money in. Okay, that means that the credit card company, they trust you enough. They trust you enough to give you a line of credit, and they're saying, hey, we think you can pay us back based on your credit score. Okay. Now, installment loans, we talked a little bit about installment loans, but these are typically going to be your auto loans, your financial loans, mortgage loans, boat loans, where you have a set monthly payment and you pay it off till it's done. And like we mentioned earlier, you can't borrow back against that installment loan. But as we mentioned earlier, in the types of credit used, it can be an important part of building your credit. But again, it goes back to, whether you should or not. And a lot of it boils down to your overall length of credit history. Now, should you add a second installment loan? Not necessarily. But going back to types of credit used, having a mortgage loan does give you a bump over having like a financial loan with a bank or even a car loan. Okay, a mortgage loan can definitely impact your credit score positively. Okay. Any questions about building credit or anything that you guys run across in regards to building credit? Ray, do you have anything as far as things you tell clients about building credit? Is pretty much what I've said, or?
Pretty much just keep balance low.
Yeah.
It's gonna be the ticket either.
Yes, definitely. So let's kind of talk. We talked a lot about the positive. Let's talk a little bit about the negative, okay? And talk about errors and things like that end up showing up on the credit report. Now, the FCC did a study and they found that 7 out of 10 credit reports have some sort of detrimental error. Okay, there's other studies that have shown that that number is probably more like 8 out of 10. And what that means is that 70 to 80% of all credit reports have some kind of error on there that can be detrimental to someone buying a car or getting a home loan, opening up a credit card, an error that they may not even know exists. We talked about one of them, the inquiries, right? That's a detrimental error that sometimes people may not even realize that's impacting their credit score. Now, most errors, though, that occur on their credit report are related to your identity, okay? Now, I'm sure a lot of people see things online or, on the commercials about, identity theft and identity thieves and things like that. This is definitely a problem, but as far as your credit report is concerned, most of the identity-related issues are more errors. And we'll talk about the errors in a second. We're going to talk about identity theft first, because it is a big problem, but a lot of times it does not rise to the level of actually getting on their credit report. But when it does, we've had a lot of success of helping clients get them cleaned off, but it can be very difficult to get that cleaned up. Now, we were talking about credit monitoring earlier, right at the break. One thing that Identity IQ does is they give you $1 million of identity theft insurance. So what that means is they'll spend up to $1 million to get any identity theft related things cleaned up from your credit report if you're enrolled with them at the time of the identity theft. Okay, so that's kind of like having like insurance, car insurance, homeowners insurance against your identity. Okay. Now, what kind of identity theft is there? Here's an example of a few. There's a few others as well. Mail theft. Pretty simple understanding. It's basically someone stealing your mail. Like the old time mailboxes. I know my mom still got one that you go to and you pull open and the mail person comes and puts it in and drives to the next one, right? But most subdivisions now have the big boxes and they put all of them in a central box with a key, but there's still people of like running us over and going and stealing the mail, which I think is completely ridiculous, but people will go to all lengths to try to steal things. But a lot of times that what they find is on what this thing's called the dark web. I know it's kind of scary sounding, but on the dark web, people will pay money for people's identity and information. You know, there was a time where it was, you know, your name and address was just in the phone book, but now I guess if people have your name and address, they can do bad things with it. Is our name and address still not in the phone book? I don't know. But people have phone books anymore. So, you know, but mail theft can be a problem. I know, like, when my wife and I, after we first got married, we had our son, we lived in like a rental house out in the country, and we had like an old style mailbox, and we had no idea that our mail had gotten stolen. And it turned out the only reason why we knew is because Chase had sent a credit card to my wife, and it was automatically approved for up to $500 to be used without having to actually activate the account first, which was weird, but
Can you do that anymore?
yeah, they still can. But it was the $500 was protected. So what happened was the thieves went to a local Target. Well, first they went to a Red Box and they tried it for $1 and it worked. Then they went into Target and spent like $350, and it was like the Target like real close to where we live. And then my wife got a phone call saying, "Hey, you purchased something without activating it. You know, did you know that?" And they're like, "Well, no, I didn't make a purchase for $350." So, but what happened was our mail was stolen. We got the police involved. We did a police report. We did all this kind of stuff. We put actually what's called a fraud alert on their credit report, which meant that, you know, anytime if someone's going forward pull credit, my wife gets alerted about it, and you can do that. You can actually set up a fraud alert with the 3 credit bureaus. That kind of adds like a layer of protection, makes it a little bit harder for people to steal your identity as a result. But it can be a big problem because people are trying to steal this information. Now, most of the time when people are doing mail theft, they're not trying to get credit cards or checks. They're really just trying to get information. They just happen to hit pay dirt when they went into our mailbox. So, the dumpster diving, this isn't an Olympic event. This is actually people diving into dumpsters and trying to, which is just crazy to me, really gross. Like, how much money do you make on the dark web off of information that you're going to go, you know, like banana peel, apple core? Oh, here's information. You know, like how much, like poopy diaper? Who cares? Oh, look, here's somebody's credit card bill. I mean, how much money are you getting that's going to worth it to go into a trash can and steal information? But it's true, people do. So make sure you shred all of your information. If you don't have a shredder, buy one, a good cross-cut shredder. Not one just like the old kind that's got big strings, you know, the one that like puts it in little small pieces. Because I guess people will also go to the length of taping stuff together to get into your information. It's crazy. Pre-texting. So this isn't something you do before you text. This is actually where you're getting some information about somebody to use it against them in order to get more information. Okay, you know, like someone knows that, hey, you went to U of H and you're a big Cougar fan, and you call them up and be like, hey, you know, this is the Cougar Alumni Association, Fan Association, whatever, looking for some more money for football, you know, to support a new football stadium or expand the football stadium. I know there's a new one on there, but you know, whatever. I mean, you're using information that they may have against you to try to get some more information, like a credit card number or more information that they can then use against you. Okay. That's what pretexting is. Shoulder surfing is literally just stealing information over your shoulder, like someone's on a computer or even your PIN number. You know, they say protect your PIN number whenever you go to the gas station, whenever you go to the grocery store. I know Walmart doesn't have the little rubber thing around there, so you always got to, you know, make sure you hide your PIN before you put it in. Fishing, again, this isn't something you do out here with all the fish were jumping this morning, so I was like, man, I wish I had my pole with me. No, not that kind of fishing. This is actually when, this is PH fishing. So that means someone sends you an email or something on Twitter maybe, and it's a link that you feel like you need to click on, or maybe it's like something from an email account that says, hey, click here, and then sign in, and then you sign in, and now they've got your username and password. Now, it's a little bit harder nowadays. Most people have two-step verifications turned on on all of their accounts. If you don't, make sure you go through your Facebook, your emails, and everything, and make sure you have two-step verification turned on at minimum. I think there's even more steps beyond that. So, I mean, it seems like nowadays, if I sign into anything, they have to send me a text message before I can finally get on there. That's just that added layer of verification that they're doing to make sure that you are who you say you are, okay? Other types of identity theft that kind of related to this is skimmers. So people can skim at the gas station. I know this happened to my wife, and my sister was telling me that happened to her recently, where you know, you use your debit card or credit card at a gas station, and by you putting it through there, a thief puts something either over it or inside the device, and it captures your information, your credit card information. And then now they have your credit card number and they use it. Now, this is more an actual credit card theft than it is identity theft, but sometimes it's kind of lumped in the same thing. Just be careful when you go to gas stations before you use your credit card. If you do feel unsure at all, go inside and pay. The other thing too that's a pretty big issue is breaches. So like what happened with Equifax, was that last year or the year before that? It may have been like the year, I think it was last year with Equifax, that Equifax got breached and had pretty much almost everybody's information. I don't think it was social security numbers, but it was all the other information about people that people had access to. So those kind of breaches can definitely be a problem. And those are usually the ones that do rise to the level of things ending up on your credit report that don't belong to you. But then also one I think that you could probably add here that I see probably more than anything, and that's where it's personal, where like, you know, somebody in the family uses somebody's information they didn't ask to use to like open up a cell phone or a cable bill, like, oh yeah, my sister, who's kind of the black sheep of the family, used my information to, you know, get, you know, DirecTV, and then didn't pay her bill, and now it's on my credit report. I see those probably more than I do actual identity theft, where it's somebody, you know, from like Russia or whatever that stole the information and is, you know, or some bot or something that stole the information. It's usually something that's more personal in relation. So, but the bottom line is, anytime these things are on their credit report, it can definitely have a negative impact to their credit score, and it can be very difficult to get those items removed. Now, we will work with people, and we are very successful in getting that kind of stuff cleaned up, to the point where we've even helped clients get lawyers to go after certain items. Because I have one client that's got a company that just refuses to take it off. Yeah, just you said it there. Just refuses to take it off. All 3 bureaus, we got to remove from 2 of the 3, but the last bureau, they refused to remove it, so we're getting a lawyer involved. So whatever we got to do to help the client get it done, we'll help them do it. But that said, when you're talking about things that are detrimentally impacting their credit score, they're identity related, it's really the errors that have the biggest impact. Now, errors, when we talk about errors, so same last name, same zip code. So if you happen to have a last name like Johnson, Smith, Jones, Gonzalez, Lopez, Rodriguez, a lot of times you're going to have things end up in your credit report that don't otherwise belong to you. Okay. Now, when we see these things that are on there, they're very easily cleaned up, but it can throw people for a loop a lot of times when they go apply for a loan and there's something that's on there like, wait, that's not mine. And a lot of times they immediately think that the worst has happened, that their identity was stolen, but sometimes they don't realize that it was just more related to their name than anything else. And then also, if 4 letters out of your name and 7 out of the 9 social security numbers match, your files will actually merge. So let me kind of tell a little story so you understand what I'm talking about. So I had a client, his name was Roberto, and poor Roberto thought that his identity had been stolen. He had a bunch of stuff on his credit report that didn't belong to him. And he's like, and I know who it is. It's this guy by the name of Robert that stole my identity. And he's using it to open up things on the credit report. So we went through line by line the items that were on there that he said weren't his, including one of them was a Chase credit card that had a $3,500 credit limit, had a $500 balance, and been opened up for 7 years. And had never been late ever. Okay. He's like, yeah, this guy Robert obviously opened up this Chase credit card on the credit report. I was like, well, Robert must be the most honest thief ever because he's actually made all of his payments on time. And you know what? It also happens to be the best trade line you have on your credit report. And the only reason why you have the credit scores as high as you do is because of that Chase credit card. So if you actually remove it, your scores are going to drop. He's like, wait, what? What are you talking about? I was like, well, turns out poor Robert did not steal Roberto's information. What happened is they happened to have pretty much the same first name, and then 8 out of the 9 social security numbers were the same. So because of that, the files merged. Now, it's easily correctable, but obviously I told them that we're not going to go after the Chase card, but the other items that are on there, we can easily get fixed and get removed. Okay.
So you kept the trade line the whole time? Still got it?
Yeah, kept the trade line. I mean, I was like, you can deal with it after you get the mortgage loan. So, unless the mortgage company, because there was a notation on the credit report that said social security number mismatch, and that's how I originally caught it. Like I knew before I started asking the questions the answer, but I wanted to kind of go through the process so he understood it. But the loan officer didn't catch the fact that it said SSN mismatch, and I called the loan officer. He was a little bit green. I was like, oh, you didn't catch this on here where it said SSN mismatch. And he's like, oh, okay. I didn't know what that meant. I'm like, yeah. You would have caught it, Ray. It never would even hit my desk. Now, other things that could be identity-related errors are also like junior, senior. That can, where John Smith Jr., John Smith Sr., one of the two has bad credit, and the other one takes the brunt of it. I see that quite a bit as well. So negative items that are on the credit report, what kind of negative items are on there? Collections, bankruptcies, BK items, or bankruptcy related items, judgments, medicals, identity fraud, foreclosures, repos, lates. These are all things that are negative that are on the credit report and can definitely have an impact to the credit score. But we're going to talk mostly about collections, and I know the gentleman asked about medical collections, and we'll talk about that as well. So collection types, medical collections, credit card collections, energy related collections, student loan collections. A lot of them will impact the scores about the same, but some of them have a little bit differences. But some of them have underwriting differences as well. So when you're looking at things, when a mortgage company looking at it, even if the score is where it needs to be, and if someone's trying to apply for like an FHA loan and they have student loans and collections, even with a credit score that may qualify, the mortgage company is not going to approve that loan because they have a student loan and collections if it's a government-backed student loan. Am I correct in saying that right?
Yeah, up under Caver's report.
Caver's report, exactly. So, and I tell people that all the time, well, hey, Chris, I'm hiring you to remove stuff off my credit report. Can't you just remove it? I'm like, nah. I remove it off of your Experian, Equifax, TransUnion, but I can't remove it from Caver's. So that's something that I tell people all the time. There's something that the mortgage company has to pull called a Caver's report, and that's one thing that shows up on there. They have to have a clear Caver's in order to go through with an FHA loan. So those kind of different collection types can impact you outside of just the scoring model. They can have an underwriting issue as well. Also, things related to like a rental. So like if you have an apartment complex or something like that, that could be an issue. Something that usually underwriters look at negatively. But I always kind of get with the mortgage loan officer when I have those type of collections on there to see, is this going to be a problem? Yes. Okay. Well, if it can't be removed, then we'll need to talk about some kind of payment plan that fits into what the underwriting department has to see. Did you have a question? Not necessarily. I've actually had or heard of clients or seen clients that do conventional loans, even with like student loan collections, because it doesn't affect the conventional loans. Is that right, Ray?
Yeah, I did one last month like that.
Yeah.
It was conventional, but Caver's popped or FHA Caver's popped up our whole position.
Yeah.
Had a little bit down.
Yeah. So,
If you ever have any physicians that are just getting out of school and kind of getting going into their career, we have some physician loan programs, because most of the
yes, there's different programs for different things. I'm gonna, here in just a second, I'm gonna bring Ray in to talk about their different programs and the different types of loans. But medical collections, now medical collections also are governed by HIPAA laws as well as, the Fair Credit Reporting Act and the Fair Debt Collection Practices Act. But the thing is with HIPAA loans, or HIPAA laws in relation to medical collections, a lot of times information does not get passed along to the collection agencies from the doctors and hospitals. So many times they don't have all the information necessary to show that the item should actually be reporting on the credit report. Because what we're doing when we go after an item on the credit report is we challenge the negative item, we challenge that negative item based on certain questions, and we ask questions about it. So a lot of times we can get medical stuff removed pretty quickly because they don't have that information on file. Okay. Now, so I don't really worry about medical collections that much for two reasons. One, because we know we can have a good chance of getting it removed, but they still impact their credit score. But the other thing too is if we can get the credit score up where it needs to be, even if there's medical collections on there, I know Ray and Abe are not going to care about medical collections. They don't count that against the fact that they don't count it against debt to income ratio. Is that right? And they don't count it against the fact that it's not going to hold you up from getting a loan. Medical collections, is that right, guys? Yeah. So, but let's talk a little bit about new versus old collections and the impact that they have on the credit score. So the newer a collection is, the more it's going to impact the credit score. The older the collection is, the less it's going to impact the credit score. So let me ask this question though before I go any further. When you pay a collection, does it remove it from the credit report? No. Anybody else? Yes, correct. Paying a collection does not remove it from the credit report. Okay? Now how many people think paying a collection will always increase your credit scores? The answer is no. So the answer is no. Paying a collection will not always, positively impact your credit score. How many people think that it can actually hurt your credit score if you pay out the collection? Yeah. I say Abe and Ray, like, yeah. So sad story I tell all the time is I had a client, it was like back in 2009, and she had, she was qualified for the loan, she was 3 weeks away from closing, home of her dreams, she was a single mom, 3 kids, went through a bad divorce, getting her life back together. She knew she had to get this home because she wanted her girls to go to this school, and it was like right in I think it was like in July or something, right around that time frame where she was trying to get it closed because she had a mid-August closing so she could get in there right so that her girls could go to this school. And then she got a call from a company that said, hey, we have this medical collection. She knew she had it. It's $800, and and this is what she was being told. She said, you can't close on that mortgage loan if you have this $800 medical collection. She was like, really? Like, yeah. So, but here, I'm such a nice guy. I'm going to give you a great deal today. I'm going to give you half off of this medical collection. So you don't have to pay me $400, and you'll be able to close on your mortgage. Oh, okay. Thank you so much. Yes, here's my credit card. I'll pay it right now. I know it's mine. I got to get this taken care of. So I got to get my girls into the school. Well, what happened to her score? Her scores dropped 50 points when she paid that medical collection. Now, she did not stop and pick up the phone and call her loan officer or anything like that, which would have told her, no, don't pay it off. You're fine. You don't have to pay it off, okay? He would have, because what happened was she was lied to completely by this collection agency. And her score dropped 50 points. She lost the home. Her girls did not get into that school, right away. So it was a disaster. She called me just hysterically in tears. I was able to go in and quickly get it removed, but not in the time frame that they needed to close. She ended up closing and finding another house, but it was kind of a really sad story. But it's an illustration of your clients, and I've said it before, you guys are on the front line, so you can tell your clients, hey, look, you have these collections. Before you just say, hey, I'm going to go off and pay all these collections off, get with the loan officer first, okay? Have Abe and Ray look at their credit report. That's what they do. That's their specialty. And if they think they need to, they can send it my way, so we can, but if you have them talk to a professional first, they'll understand that maybe they need to pay this off, maybe they don't, okay? There are circumstances where, like student loan collection, you gotta pay it, right? But if it's a medical collection, paying it may not be the answer right now, okay? I'm not saying don't pay your debts, but just gotta be smart about it. But the reason why the score is dropping, so when you pay an old collection, going back to what I said earlier, a new collection impacts your score more, an old collection impacts your score less. So when you pay an old collection, what are you doing? You're renewing the activity on that collection, and so now it's just like a brand new collection again. So that's why your score is dropping, okay? So you just gotta be very careful when it comes to paying collection. And we hear this all the time when we're talking with clients, and they'll say, you know what? I don't really need your service. I can do this on my own. That to me is a trigger word for, I'm gonna go pay all my collections. And if they still don't want to do business with us, I'm gonna call the loan officer and say, hey, look, just FYI, I think this guy's gonna go up and pay off all his collections and his score's gonna drop, and he's probably gonna be humiliated and not call us back, but you may wanna call and talk him off the ledge. And if you guys are involved, we'll probably call you as well, be like, hey, this client you send over to us, they think they can go do this themselves. They think going off and paying all these old medical collections and utility collections from 6 years ago is going to help their credit score, and it's not. They're going to have a world of hurt come down on them when they do this and pay all this money. So you need to help us explain to this client that what they're doing is a bad thing. And sometimes it's like, well, why am I paying you $50 a month when I can just go pay this collection? Or is that $50 a month that I'm paying you going to pay this collection off? Well, no, it's not. We're trying to remove the collection, and that's what's going to help the credit score. Okay? Does that make sense?
If you're like a year out from buying a house and you do have a collection and you do pay it off, is that better than getting to the point of application?
If you're a year out, it still depends. Now, there are times we'll have people pay off collections. Usually what we'll do is we'll look at the date of last activity, and if it's a newer date of last activity, there are collection companies, they will renew that date of last activity every single month, okay? Now, if we can't get it removed through our process of investigations, we may have them go pay off the collection. The reason why we would have them do that is because it may increase our chances of getting it removed. So a good example is, let's say, First Premier, which is a credit card company. They do secured credit cards of sorts, but they charge a lot of people off because it actually they make it very hard for actually them to pay your bill, because you have to pay a fee if you pay it online. If you don't pay it online, you got to send them a check, and who even knows where their checkbook is anymore? And so I see them all the time, First Premiers that get charged off on their credit report. They're very difficult to remove when there's a balance, but they will usually take a 20 cents on the dollar settlement on the balance. So let's say it's $450 balance. They give them $90, boom, it's paid off. It now shows settled, paid in full, $0. And this is actually an example of where a paying off a collection can actually help your credit score, because it's showing a $450 balance on a $300 limit. They're 150% utilized on that particular trade line. So I hope I didn't blow your minds too much by telling you this, but by paying it down to 0, that helps your utilization score in that 30% section. But then it also gives us an almost 100% chance to get it removed, because I know that once that First Premier is paid and I go after it and investigate it, I would say 95 times out of 100 we get it removed, right away. So I usually will tell people when I see First Premier, the first piece of advice I have is go settle that thing right now for 20 cents on the dollar. They'll take it, and then we'll go after it and we'll get it removed, and you're going to see a pretty big jump in your credit score as a result. So those are things where we go through systematically with a client in what we call the credit coaching, and we might put together a plan of pay this, pay this, pay this. Or that process may come later on in the process, like, all right, we know that these things are impacting the credit score. They have a very new date of last activity. We need to get this off of here, and our best way to get it off is by you settling it. So here's how you settle it. Once you settle it, then we'll go after it, and we'll have a good chance of getting it removed, because now they've got their money. It's like, well, who cares about trying to collect on this? We've already been paid. Does that make sense? So this last slide here is impact of credit on buying a home. This is where I bring in the experts here, Ray and Abe, to talk about the mortgage programs that they have for the different loan types. I guess the one I don't really have on here is USDA. But if you guys want to jump in and kind of talk about FHA versus conventional versus VA versus USDA.
Yeah, so again, we offer all those programs. Typically, recently, we've seen a lot of first-time home buyers go the conventional route, mainly because a lot of them do want to utilize down payment assistance. The conventional with rates are right now, they're able to utilize a lot more assistance. But just kind of give you an idea of credit score requirements and things like that. For FHA, usually you want to see something around a 560. However, you do need a little bit more now. If you get to that 580, 620 spot, just get it there with a minimum of 3.5. In some cases, we can go lower than a 560. For example, the lowest I've ever done was a 551. But we were able to get it done. There were some different steps we had to go along the way to kind of knock that one out. But it did allow that home buyer to get that home without doing it. VA, I believe it's at 620. I believe in some cases we can go lower, sometimes with manual underwrite. But on conventional, you typically want to see something around the 660 with 5% down. We can go lower in some cases with more compensating factors, more down payment, tolerance, things like that. Then we also offer non-conforming loans and programs. We do have one out that I believe for a 5% down jumbo with no mortgage insurance. However, the rates are going to be higher. We'll look at what it is in option. We have a couple of options as well for bank statement loans, where you just utilize 24 months of bank statements, look at their deposits, and kind of utilize that for them as well. So it's a lot of information, and I can send you literature on it, but for me to go in depth and taking the notes, it's crazy just with the evolve and how the mortgage industry has evolved. So keeping up with this information is kind of taxing on us too, but we try to keep up with the different products that are out there and kind of offer those things there. So, if you want some more information, we've got to talk some more about it. It's fun.
You got anything? You got anything, Abe?
Yeah, so I would say we're one of the most flexible lenders with the vast products that we have to offer. So, just giving us a shot would mean the world to us. If we can't get it done that day, we'll figure out a way to do it. That's kind of our thing, is not letting anything die, just doing whatever it takes. But just my thing as far as kind of my little nuts and bolts of breaking that down is conventional is going to be your strongest buyer. FHA is going to be the one that might need a little bit more love, that has the most flexibility. VA, obviously, you need to be a veteran, but it's the best loan program out there. So if we have a veteran, we'd be stupid not to take advantage of that. USDA is like a conventional loan, but it's in rural areas. So you have to put in the address on the USDA site to see about if they would qualify. Basically, it's based off your income and your family size. That's another great program to utilize, but you need to be kind of more in Alvin, a little bit more south.
Got a few folks here that concentrate on a Santa Fe area, so a lot of y'all would qualify for one of those.
There's a little sliver of Dickinson also that qualifies.
Yeah, I think you mentioned it before.
Yeah,
Dennis.
you can't find a house in there, but there's a little sliver.
That's 100% financing, so that's a really good one to take advantage of.
Yeah.
That's how VA is too.
Yeah.
And some of our niche products, like the ones that are, you have to get really creative, like bank statements or jumbo loans. I mean, the first question is, do you have any money saved up? Because those are gonna have, you're gonna have to put a little bit more skin in the game, but we'll figure out how to make it work. Thanks for all this good info.
Yeah. Question?
About 620. Well, you really want to try to be a 660 or 680.
ways to go lower than 660. However, you have to get the automated approval through the automated system, which going lower, it is very, very difficult.
They have some algorithms too.
You just gotta figure out what allocation works, but I think that you can do it. Just hope that that bar has a lot of compensating factors and reserves. I'll give you an example. Going back to last month when I closed that had the FHA with the cable issue. Well, he had a credit score right around the 660. We were conventional, which we were able to get it done. However, I had to use 100% of his 401k as reserves. I didn't use it for down payments and like that, but I had to show like 60K extra in the bank account in order to get the automated system to work.
I mean, and that's why I always say, get it to these guys first before you come to me. They can work a lot of magic on things, and then if it needs extra help or extra love, they can send it to me. Now, a lot of times I also say too, that, okay, great, they got into a home loan with a 550 credit score. They probably still need to come see me after they buy the home because they're still gonna get hosed on their insurance, their homeowner's insurance. They're still not getting a good rate on their car insurance. They're still spending a lot of extra money every single month because of a bad credit score. And they may not even be getting into the best rate with what they're doing there. And so they may be able to come back and refinance later on and get into a better rate. So if you're getting into a rate at a 660 on a conventional loan, that's not the best rate. The best rate is gonna be if you've got a 740 or 760 credit score. So those kind of, you can be that fiduciary person to your client, say, hey, look, that's great that, you know, Abe and Ray were able to get you into this down payment assistance loan, you know, at a lower credit score conventional, but you know what? If you go into credit repair and get your credit cleaned up, get your scores up, you can go back and refinance later on. Would you guys agree with that?
Exactly, and then it gives you a better chance to be more connected to your client, and they'll appreciate you going above and beyond to help them get through that, or you know, find better ways to better their life down the road as well.
Yeah, they're going to save so much more money on so many other things. And I have clients all the time. They're like, "Hey, Chris, I need to get to a 600. I'm at a 601. I want to cancel." And I'd be like, "Well, I don't agree with your statement. I think you need to stay in at least." And I had one recently where he canceled before he closed, and then something else happened on his credit report. His score dropped, and we weren't able to pick it up in time to actually help get that thing corrected. So now he's like a week away from closing. They're like, "Oh, Chris, can you do anything?" I'm like, I don't know. He's the one that canceled his service, so I don't know why he did that. Oh, well, he thought his scores were there because he had 1 point above what he needed. I'm like, and I told him that's not a good idea. So again, you guys being the realtor on that side need to be the person to say, look, you probably need to see this thing through the end, and you need to probably stay to see your scores into the 700 FICO range. So that's really where you're going to see things go down in their lives as far as money that they have to pay out every month. So that's all I got. So did you guys learn something today?
Oh, yeah, absolutely.
Good. Would you recommend this to other realtors to come in and see it? So we're trying to do these classes here every couple months here in Seabrook. So if you have realtors in the area, definitely recommend them. But you can also, we would love a great review on our Google page in Houston or our Facebook page, where not necessarily about our services because you don't really know about that yet, but if you can at least give a mention about the class itself, that will let other realtors in the area know that they need to come to this class. And you can always point other realtors to Julia as far as future classes that we have here at Sam's Boat. So,
Do you have a class that you offer?
we do home buyer seminars. I've done plenty of those. So
So if we wanted to come to our office, if we wanted to hold an event or something,
yeah,
you would come and do that?
absolutely. We partner up with these guys right here.
Okay.
Would be a good thing to do, and come in there and do a home buyer seminar. Maybe get 8 to 10 people in there. However you want to do it. Usually on like evenings is what we find are best. Sometimes on the weekends, but I don't usually, either myself or people that work for me make them work on the weekends. So sometimes a weeknight is usually the best thing to do.
But yeah, we would love to schedule home buyer seminars. We do them all the time. So I think one that our Austin rep did recently, she did a kind of a credit seminar for high school students. So there were probably about 20 high school students that showed up there to just kind of give an introductory to credit, so they give an understanding and a base of what credit and some financial responsibility around credit is. So we do anything we can to kind of educate the public. We'll more than happy to do it. So, but that being said, we're going to turn it over to a very cool display. I think she's going to fly her drone around here and like chase you with it. No, I'm kidding. It's like get your running shoes on.
All right, thank you very much. I'm Denise Helms. Our company is Drone Services, and I did not expect to learn so much today, so thank you. I really, really appreciate that. Yes, thank you. That was great. I just have some brochure books just a couple of quick things I want to go over. How many of you are currently using aerial photos or video for your listings? 100%? Okay. All right, awesome. That's very good. You're going to see this more and more as more realtors try to sort of get the edge over your competitors. Aerial photos is really a good way to make your listing stand out from the rest. Right now, you guys, you're low on inventory. It's kind of tough competition out there as far as getting the attention of consumers. So aerial photographs and video in your listing are a great way to do that. Two things. Some of you are, I meet realtors all the time who are using their cell phones to take photos of their homes. Most of the time that works great, but my mom always said you only get one chance to make for a good first impression, right? And it's the same way. This is never more fun than in real estate listings. That is the very first impression that this potential buyer sees of that home, of that property. And so you want to show it in the best light that you possibly can. So using HDR photography is really important, whether it's ground photos or aerial photos. HD photos are really good. And brief explanation of what HD photos are. These cameras on these drones and other fancy cameras have the ability to take 3 shots or 5 shots in a row. Same shot, but different exposure. And then it takes those 3 or 5 exposures and their software stitches them all together. And what that does is create more data in that photo. I don't know how it works, I don't really understand. I'm not the IT guy, but lots of data is really good because then when you go to do or editing on those photos, we have more data to work with. So you get lots more detail, better colors, better clarity. And these drones can do this. I've got two, we have a whole fleet of drones. This is the two that we use the most. They're all made by DJI, a company called DJI. They're by far the very best. And they've got GPS and they use satellites and the technology on these is really, really incredible. This one's called a Phantom 4 Pro. This one's called a Mavic Pro and a Mavic Air. They will take amazing video, 4K video, 1080p also, and HDR photos. This one is great because the props actually fold up on themselves, and I fit it in this bag. The controller, the drone, all of that is fit in this bag, so it's great for travel. This is the controller. You put your iPhone on here or an iPad on here, and that helps you to see what the drone sees. seriously. You can expect communication and impeccable customer service from us 7 days a week. Real estate is not a 9-to-5 job. We all know that. And we do everything we can to get it approved and not from my end, my job is grant relations specialist. I have tools that I like to offer y'all to try and help y'all be successful. I have the ability to make personalized property websites. So if you have any listings, I can make personalized websites that are branded with your information to help you sell your listings. They're in very friendly formats. You can share the sites via social media. Click on a button, you can share your Facebook, your Instagram, whatever it is that you like to use. I can make flyers, some of them like generalized marketing flyers for you. I can also make flyers specific to your properties. I would make a single page that has just a couple of photos and some financing options, or I can make multi-page flyers that have area demographics, schools, leave times, taxes, you name it. So that's something we like to offer you guys. We also, if you're ever on the road, we have a private office in our space upstairs that overlooks the water. If you ever need a place to come work when you're on the road, or if you need a good place to sit down with a client, we're welcome to have you in our office. I just ask you to call me so we make sure that it's not booked, someone else isn't using it, etc. That's something we want to offer you guys. And overall, we just start looking to be creative. If you're looking for assistance, my job is to work for you because I want you to see the value of using it. If you want to get creative and sit down and have lunch and brainstorm ideas and we can market ourselves, I'm open to that. If you want to do a home buyer seminar, we're happy to partner with you for that. Come to your agency, whatever you're looking for on that end. If you're wanting to do some like target marketing campaigns to try and target some specific neighborhoods, areas, we are open-minded and ready to kind of trial and error, see what works, see what doesn't. So we just really appreciate you coming here, giving us a chance to meet with you, and we'd really be honored if you would give us a chance to work with us. You know, if you give us a chance to learn loans and improve ourselves, we keep coming back. So, thank you.
I have a question. Yes, and I don't know what everybody else's demographics are, but we're at Busch. So what we're seeing a lot more of is condominiums, and we have home comes out there. So do you finance condominiums?
Oh, you guys.
Unfortunately, we don't have a barndominium outlet right now. We do manufactured homes.
You do? Okay, that's good to know. Yeah, okay, great.
Any other questions? All right. Let's see who's lucky. All right. First prize is going to be an awesome cup coat knife. I think they range about $80, so it's a nice prize. Nate, do you want to go first? All right. 31640. Yay! Awesome. There you go. Next prize, we have a couple of any day tickets to Typhoon, Texas. It's the water park out in Katy. This weekend they're open every day for Labor Day, and then since we're kind of nearing the end of the water park season, throughout September they're open on the weekends. They're $40 a piece, so if you want to get with your kids to go have a fun day, or if you dare, go with them. During water slides. 316-046. It's got to be somebody in here.
Oh, that's me. What was it?
046.
Yeah, that's me. I was over here yapping. What's me? Just make sure that's right.
Yes, you're good. Okay. All right. And the last one, you'll get a couple more days out of these. Nice little floral arrangement we were using for decor. If you want to take to your office or put on your kitchen counter at home, it'll make you happy.
kind of out of commission and running around with our heads cut off through the new year. So I'll get information to y'all on that. All of our cards and contact information is in your folders, and from time to time, I'll give y'all a call, check in, see how things are going. And like I said, we're open to our policy, so give us a ring anytime. And big thank you to Denise for showing us her cool drones and for lunch. We really appreciate it. And I hope y'all all have a good afternoon.
Thanks, guys. Make sure if you can give us a great review on either Google or Facebook, and then also like our page. What? Yeah, so my card and Erica's card and our flyer should have been with your package. But I can certainly give you another one if you lost it.
Yeah, it's just a little bit of information, just a tiny bit.
Yeah.
Just 3 hours worth.
Okay, good.
No big deal. Yeah.
Usually for new loan officers, I mean, we work great with them because a lot of times they're trying to understand that sometimes what's best way to show another recruiter, be like, hey, how can I earn your business? You take those things.
And I live in Friendswood, and I'm currently working, I'm very good friends with Stanfield. So I'm currently working with some friends just because I'm not so really switching over. And some of them like, so I'm like, hey, I'll help you out. Come in January, and money will have to get
I just saw it on Facebook. I wonder how high